próximos minutos de la mano de Carmiñac. Y nos acompaña ahora mismo Axelle Pinon, es Manager Equity Product Specialist en la gestora. Axelle, thank you so much for having us. Good afternoon.
Thank you for having me.
Axelle, we have today the data of eurozone inflation. He saw how has been revised marginally lower to 10.6%. The last data, the preliminary reading was 10.7. This new data revised is still in record heights, and next month the ECB has the last monetary policy of the year. What can we expect about? Can we expect an ECB more relaxed? What do you think?
Yeah, there is still 4 weeks to go before the next ECB meeting, but we had the inflation number, we had some official making comments over the last day. Everything is just filling the debate of what ECB might or might not decide. So at Carmiñac, really our view is that on the inflation front, on the contrary to the US, core and headline inflation are still accelerating in Europe. And we are seeing a broadening inflation that should remain ahead and not behind us. So we see the sequence as follows. We see core inflation that should keep rising at least until January. And then we see a plateau around 4% during H1 next year before moving down to the target. So within this framework, what we can expect from the ECB to do. First, we have to keep in mind that the main difference of Europe versus the US is that the nature of the shock is very different. In Europe, the shock is coming from higher commodities, food prices, which means that some of the demand destruction is not deflationary, which makes the job of the central bank quite different. And today, the ECB is still behind the curve with spot real rates still negative, but we think at the market clearly that they might slow down interest rate hike in December, like all the other developed central bank, with only 50 basis point increase next month because recession is coming and there is growing uncertainty about the impact of past hikes that it can have on real economy. But we think that ECB will keep rising rates, at least until a terminal rate around 2.75%. Market is already pricing 3%. And we think that in December, they will share the details of the quantitative tightening that might start as soon as January. But for that, we will have tomorrow an important release, which will be the TLTRO repayment and redemption. And that is important because the TLTRO repayment will drive incoming ECB passive quantitative tightening over the next few quarters, meaning that quicker the banks are repaying, more the ECB balance sheet is shrinking, and less urgency we have on the QT front. So on the fixed income side, what are the implications? At Carmiñac, we maintain overall a negative bias on Europe because rates may have tightened a bit too much over the last week, with the 10-year slightly above 2% in Germany, which we believe it's a bit too tight considering that we still have double-digit inflation in Europe and with this discussion about QT coming ahead.
And Axelle, meanwhile, one of the most hawkish Fed members, James Bullard, insists on keeping the rates of interest rates. And we know that the possibility of a pause in the US has been discussed, no from the Fed members, but it was discussed in economical media, of course, but he's ruling it out. What do you think about the next movements that we can expect now from the Federal Reserve?
So for the Federal Reserve, what is concerning for the Federal Reserve is the consumer. And we had several figures and data point on the consumer side over the last days. Yesterday we had the retail sales that posted the biggest increase in 8 months in October. We have 69% of the 13 sectors of the retail sales that are up on a month-on-month basis. So we clearly see that the consumer continue to prove largely resilient. And what is important is that yesterday retail sales are not really capturing the services spending. And we know that the American has been shifting their spending from good to services. So we might get an even higher figure on the services front. So after the both CPI and PPI numbers that were below expectation last month, we had this sharp rally in bond and stock market, but definitely with this retail sales figure, it might complicate the argument pushing for a slower pace of interest rate hike in the coming months. But what we like at Carmignac is looking at macro data, but also making a cross-reference from this macro data, especially on the consumer side, because it's a big worry for markets and for the Fed, with what company told us during the earnings season. And what is important is that we should not be misled by Target's disappointed results yesterday, because Target's, the big retailer, the big US retailer really appear to be an outlier for now. Because the main issue with Target is, like most retailers, Target bought way too much of the wrong kind of good inventories during the pandemic, and they are having trouble working down the excess more than their peers, actually. But otherwise, besides Target, we have seen some resilience on the US consumer front from Amazon, but also from all the big banks, big American banks, like, for instance, Bank of America, which are showing exactly the same than the macro number, the resilience of the consumer, which proves that definitely the Fed has not done the work yet. So we might expect a peak rate at around 5.1% in March from the Fed, then a plateau for 2023, and then a cut to 1.5% in 2024, 2025, because what we are expecting is definitely a hard landing in H2 next year for the US. But this hard landing will be because at some point the consumer will weaken.
Well, as you said, we are seeing how consumers in the US continue to spend despite the inflation, and we saw it yesterday with these retail sales that surged by 1.3%. So we are seeing consuming spending still resilient in the US. And meanwhile, about equity markets, we are closing now the 2022 year, and we will start a new period in 23. What can we expect now from equity markets next year?
So 2022 has been a roller coaster, especially the last months. And we think that 2023 could remain a roller coaster. Markets are moving with a lot of macro data points, a lot of central banks talks, etc. And we saw, for instance, over the last week, the rebound was really fueled by hopes of US soft landing, better news on the growth front in Europe, better news on the Ukraine front, the hopes that China will finally reopen. But definitely we have seen that the market might be a bit too optimistic in a way too short period of time. So what we are trying to do and what we are looking at for next year is what company are telling us. And if the 3Q earnings season has somewhat appeared less bad than feared, because we have to keep in mind that Q3 figures were backward looking, so they are not reflecting yet the deterioration in the macroeconomic data. We should see coming next year the effect of the economic recession and the effect of tighter financial condition. So we think that going into next year, S&P earnings are likely to fall further, because if 2022 S&P earnings are already down to around $220, for 2023, we are still around $230 for the earnings. So we need to see a drop, especially still in the mega tech cap, because they are facing pressure on their margin, pressure that we have seen already in Q3, but should last even more going into next year. So we think that going forward, the market multiples seems really unlikely to rise in this context. But what is important is that we should see some disinflation in the coming months, especially in the US, which should be a relief for growth stocks that has been under a lot of pressure in 2022. But as we will not go back to the 0 to 2% inflation framework, the one that we used to have over the last 10 years, we should have inflation more around 3%, even 4%. Therefore, we keep an extreme cautiousness on valuation because we think that cautiousness is required on the valuation front. And therefore, what we do is targeting stocks that have resilient growth, that have a reasonable valuation. And in any case, we are very convinced that market will remain highly volatile, requiring a lot of flexibility in the way you manage equity exposure.
Well, thank you so much for all these analyses, for bringing us some light of the picture in global that we are seeing now in markets. Axelle Pinon, Manager Equity Product Specialist in Carmignac. Thank you so much, a pleasure.
Thank you.